Hey guys, welcome back to Lucid Trading. Welcome to this beautiful, I would say, downturn in the markets. It's been crazy. It's been absolutely crazy. Many stocks that we cover still in the red, absolutely bloody. The markets right now are most definitely in a substantial correction. But the funny thing is, it is not the whole market that is necessarily crashing right now. It is part of the market that is crashing. That's, I would say, mostly the growth stocks and the tech stocks. And you can see right now, Tesla's down another 5 percentage points in the pre-market. We've got Palantir down 6 percentage points in the pre-market. Even Apple and Amazon, Apple down 2.3 percentage points. Amazon down about 1.5 percentage point. So, basically, growth stocks, tech stocks, all of them, all down right now. S&P 500 as we speak is barely down, I would say. In terms of like to proportion, the S&P is not down that much. I do think we're now at a crucial level. If it doesn't hold this level, we will see a significant downturn, possibly going back all the way to the 3,700s. So hopefully it will hold up this support area, and if it doesn't, then it will be a major sell-off that we're going to be seeing here. It will be quite worrisome. Welcome back, everybody. Welcome back to the live stream. Good morning, good afternoon, good evening to everybody out there. It's been a roller coaster in the stock market at the moment. But welcome back, everybody. Welcome to Brunex, Dylan, Stewart, Empowering Physiques, PG, Newt, I can't pronounce that. Tanisha, Bryce, Baron Tobias, William G, JG, S, Sal, Corey, Yasin. It has indeed been a bloodbath, absolutely horrible. Let's check out CCIV. Remember, guys, I said for the longest time, anything above $40 on Churchill Capital IV, which is going to be Lucid Motors. The merger announcement came in. I specifically said when the merger announcement comes, you will see CCIV drop off a cliff. I said it was going to go to the $40, right? $40 to $30. See what's happening right now? Oh, surprise, surprise. It's down to $39. So, we were right on this one. I would say I've been saying this for the longest time. We even have a pattern that points it out. It's going to go down. Look at that. It went down on the merger announcement, which is no surprise at all. It's now at a support level, which is roughly the $37, $38, which is, it's holding it quite steadily. Market cap has still not been adjusted for the merger, which has not happened yet because we had the merger announcement. So very soon we'll see what happens with CCIV during that merger. I think it's going to take a while first. Let's see. Yeah, my throat is really dry right now. Just recently woke up drinking some iced tea. Yeah, so I think, like I said yesterday, this is going to be another buy the dip opportunity in many beautiful growth stocks, tech stocks alike. Keep in mind, it is not wise. I have been repeating this for months. I think since November, every single day. It is not wise to go all in. This market is very bloated. We are not investors right now. We are swing traders. Keep in mind, I do not give financial advice. I am not a financial advisor. What I say and what I draw on the charts is for educational and entertainment purposes only. But I've been saying this for the longest time. Swing trading is the way to go. You never know what could happen in the markets when the PE ratios are sky high, inflation is coming. This is why I was not invested. I was just swing trading all the time. People were asking me, Gara, why are you not just holding a couple stocks, waiting for a couple of years? This is the reason. We're going to see significant downturns ahead. And I genuinely believe markets are still overvalued, even at these levels. The market being overvalued doesn't necessarily mean the market is going to crash, though. So keep that in mind. I think we could see higher levels, but I'm not going to be investing at these higher levels. I'm going to be swing trading. Keep in mind, obviously, maybe 10 or 20 years down the road, you would look at the stock market chart and be like, hey, why did you not invest? The stock market went up. Well, because we could also invest later, like when the market is less less richly valued. And I would also say swing trading also gives you some time in the markets. So it's I think you can go risk off by swing trading, but this is not for everyone, I would say. A lot of people have a tough time doing that. Thinks that Gara is not. He's not a cat. He's not a financial advisor. Exactly. All right, so the idea behind my strategy right now is just wait and see what happens with stocks. If they're still down substantially, dollar cost average. Tesla is now sitting at my buying zone. Honestly, I just bought some more Tesla. I bought at 740. I even bought at 780, 740, 715, and now I'm going to buy at the 670. And I will do that because I'll get my average cost on Tesla stock lower. Meanwhile, some people went all in. Keep in mind, there are several people that I saw in the live chat and also on the Discord saying, hey, I'm going to go all in at $850 or $900. And I'm like, guys, come on. Let's be real. Tesla stock has gone up quite a lot. What is the chance that it's going to go up in the worst quarter? Keep in mind, this is the first quarter of the year. Usually the worst quarter of the year for Tesla stock, for Tesla as a company. So this is why I was very cautious. This is why in December I said, guys, there's a high probability that Tesla's going to come down to $650. We're getting pretty close to that 650. Keep in mind, even though I did say that I would buy below 780, small amounts. And then as it goes to that 650, I would buy more and more and more. If it goes below 650, I'll keep buying more because I do think Tesla is going to be the future, and I do think they have great products, great leader. They're growing really fast, and they're even profitable at this point, I would say. Well, I mean, that's a bit questionable, but still, it's still looking quite good, I would say. And I think we're going to see a rebound very soon because we have several gaps that need to be filled. We have a gap right here to the 780s. We have a gap right here to the 717s. And we're going to reach a strong support zone. So as we reach that strong support, there's a high probability we're going to bounce off of that, fill several gaps, and possibly come back down again. Yeah, that's a possibility that we go down again. Surprise, surprise. This is why I'm swing trading. If I get my, if Tesla shares go up above my own position, I'll probably take some profits because I do know that the markets are very volatile. And, it's quite richly valued right now. Give me one moment. Got a runny nose again. But yeah, let me know in the live chat. What do you think about Tesla going to 680? Yeah, I'm still having a runny nose every now and then. It really sucks. Let's see what's happening in the live chat. What should we buy? How do you explain them being worth more than auto? Well, how you can explain this? Well, they're growing more than any auto competitor. They're growing really fast. If you think about it, it's like it's the same thing when Apple came into the competition with their phones. They used to be a very small company. Apple was quite small, actually, like very small in comparison to Nokia and BlackBerry and the rest. But then Apple started to scale up, and as they scaled up, they added different products, and now Apple is the biggest company on the planet. I think something similar is happening right now, where a lot of people are going to prefer to buy a Tesla over any other car. However, keep in mind, we're now seeing more and more competition entering the EV space. So that is definitely going to be challenging Tesla's stock price as a whole. But yeah, I'm going to do a little bit of an analysis, a technical analysis on Tesla. See where it's heading. See if it could be heading lower. Let's get some crucial supports in here, all right? Let's see. So I think this would be the first area of support, like a really strong support area, historically speaking. Around the 655, roughly speaking, 654. That would be a support. I think it's definitely going to be holding up at that level. However, we're also right at the resistance, previous resistance, and it might act as support. So I'm going to assume that it might do that, and we're not going lower than these levels. Well, I mean, we went a little bit below them. So this might just be the zone where it bottoms out temporarily and bounces back to the upside to fill that massive gap that we have seen. That could definitely be the case. Do we have a long-term trend line? We actually Tesla's looking like it's falling off a cliff here because we don't have strong supports. We don't have a strong trend line that could like make it go back up. Maybe we have some EMAs like the exponential moving averages. You can see we crossed recently on the MACD. I remember saying, I stated this very, very recently. I said, guys, us going down on the daily, that cross right there, that's going to mean we're going to go back to 650. I said this in January, and we're now at 670. So the RSI is getting to the oversold level. Usually when we go oversold, we see us bottom out on Tesla. That's kind of what happens, generally speaking. So if I look at the EMAs right now, let me just look at the EMAs. We're now below the 20-day EMA. We're below the 50-day EMA. In fact, we're getting close to the 100-day EMA. Historically speaking, we bounce off the 50-day moving average, right? We bounce off the 20 and 50. We're below both of them, right? So definitely very bearish, right? So but we're getting close to the 100-day moving average. So I think what's going to happen is we're going to pretty much bounce off that 100-day moving average. Worst case scenario, we go to the 660s, maybe 650s. We bounce off that. We see a rebound to the upside. That is what I think is going to be happening here. Worst case, we're going to go back to this trend line, which is going to be roughly, if we could draw this properly. So imagine that we see that like the absolute worst case for Tesla stock. That would mean that in March, Tesla would be roughly, let's say it goes down, we bounce off, and it goes down again. We could potentially hit $570 to $600. That range could be a possibility. I actually pointed this out 3 months ago. Remember, in December, November, if you guys remember that, I said several times, worst case, it could come back to the 570s, the upper 500s, and it would be like a short downturn, like a very swift downturn to the 570s, and then gradually come back to the 600s, and then gradually go to the 650s. So that was what was in my mind back then. I was like, hey, it could definitely see something like that. But keep in mind, this trend line is using data that was before the S&P inclusion, so it might behave differently. So that is why I think a strong support area is going to be the 650. If it holds that 650, if the market's going to go bullish again, NASDAQ goes bullish again, we'll see that being the bottom, the definite bottom for Tesla stock. So there are several scenarios here. Oh yeah, we've got roughly 25 minutes left until the market is going to go open, so that will be very exciting. Let's see if the markets are going to be rebounding from here. There is a chance it will, because everything right now is oversold. It would be crazy to see it just drop and drop and drop without any kind of consolidation. So this support area is very crucial. If it breaches that, then I would be very worried. So I'm thinking at least so I want to see like when we see like a downturn like this, what is generally the rebound that we see on Tesla stock? So how do we figure this out? We look at the RSI. When have we reached such RSI, and how does it behave? How many percentage points does it move back up? So we had one in March. I don't think we can count in March. Yeah, the last time we were this oversold was like in 2019, though, so we can only use recent information. Let's see, this downturn we had roughly we went up about $150, right? That's like, well, $130, $140, which back in those days, I mean, that's crazy amount, right? It's like roughly 40% or something like that. But relative to this downturn, because how much did we go down here? Like a 30% downturn, 40% upturn. Yeah, so it's a tough one. So let's just look at the dollar amounts proportionally. It's $170. This was $120. So in terms of just dollars in general, it recovered about roughly 70 to 80% of the downturn. So say for example we bottom out at 660, 650. If it like recovers 70 to 80% of the downturn, well, that would mean because from 650 to 900, well, let's just choose 900. It's about $250 from bottom to top. So if we get like a recovery of that size, that would get us back up to roughly let me think about it. Like let's say it goes up 70% of that. We see it go back up. 100. Yeah, it's roughly $180. So yeah, we could go back to the 820s, 830s on a very nice rebound. But I'm gonna say it's gonna go back to the 780s because there's the gap right there. That makes the most sense. We actually filled many gaps on Tesla stock. That's kind of beautiful. Because we had, if I can show you on the daily chart actually. I remember saying this at the time. These were like, I said these gaps were going to be filled 100%. We had several of them and we filled them all pretty much. So in terms of downside gaps, I mean, even this one was filled previously. Like we don't have any gaps to be filling to the downside. So so yeah, if anything, we will see a very nice rebound to fill several gaps that we just recently made. And if you guys don't know what I mean with gaps, this is a gap right here. Right, this is a gap. We did not see these prices. It just jumped. This is a gap. Well, that gap was filled. So we have two strong gaps right here that could potentially get filled the coming weeks. I would say maybe even the coming days, given how fast everything moves now. So yeah, we're very oversold. So I'm expecting it to might go down to the 650s, consolidate, gradually fill those gaps. And then head back up, fill this gap as well, which could be meaning that we go back to the 780s. But that's going to be a very, very strong resistance now. So the question is going to be, are we going to be, are we going to be going above that? We do see Tesla move quite fast when it kind of bottoms out and rebounds. So this is not a unrealistic move. This is kind of the move that I was buying Tesla stock for. I'm kind of waiting for that swing to the upside. Yeah. Hold up. Given that the markets are not going to go back to back negative, like, oh, another percent and another percent to the downside and another. If that doesn't happen, I'm very sure Tesla could see a rebound here. I want to check some different stocks out there. See what's happening in the live chat. CNBC CCIV live. Oh wow, people are still hyped up about CCIV. My gosh, I mean, we had the news. People sold the news, which was quite obvious. Yeah, Tesla's look. I think many stocks are actually looking good on the short term. Like we're gonna see a bit of a rebound coming in. C3.ai has not updated yet, so it makes no sense to follow up on that. Okay, so Palantir, I did say, hey, we're going to top out and go flat. Well, timing was a bit different, but I mean, the pattern comes very close. It's time to delete that. We're going to look at it in a different way now. We saw this gap right there. 100% is going to fill that gap. 1000%. It will be filling the gap to the upside. The same way this gap was filled. Yeah. We have the $25, which is acting as a strong support. So, if anything, we are already kind of bottoming out right here on Palantir. So, I am not worried that Palantir is going to go lower. Unless we have back-to-back sell-offs on the NASDAQ. Obviously, that's going to have a major impact. But it seems like we hold that $25 regardless. And it's now 26. Having a tough time going below that 26, actually. And we're very oversold on the 30 minutes. We're actually not... I don't see it being oversold on the 4 hours. Not yet. So, yeah, it could go back to 25. 25, upper 24. And see this, well, W recovery, right? So, let me delete this as well. Although we see a downturn right now, it doesn't necessarily mean that we won't see it heading up. We have a £10 donation coming in from Vincent Weck. Thank you for that, Vincent. Oh, I'm noticing that the camera's kind of acting up a little bit. The green screen, I would say. Hold up. See if I can fix it very fast. Yeah, there's just a lot of light coming in because it's very sunny outside here. It's actually pretty great. Great weather. Great weather, but the stock market is not as great as you might think right now. Would have been nice if we wouldn't see a massive sell-off in the tech sector. Nasdaq, oh my god, look at that. It went below the bearish channel, so it's like, yeah, we are definitely in a very substantial correction right now. It's not even holding the trend anymore. That's how bad it's getting. Like, we're in a significant downturn. We have several gaps right here. Let's see. Well, I mean, it makes sense. The NASDAQ, well, this is the QQQ that is tracking the NASDAQ. We did get, like, very overextended here. I'm going to go back to Palantir in a moment. I'm going to just look at the NASDAQ, because this will determine where stocks are heading. At least the tech stocks, the growth stocks. So we had this rally here, breached it right here, had a bit of a correction in September. Kind of had a rally right here. Then we, I mean, it's still kind of holding the support. You know, it could rebound. We have a gap right there, so it could fill it almost immediately if it's allowed to do so. And we're also oversold on the 4 hours, so who says it won't? And if we just draw a trend line. Yeah, I don't know about that. Yeah, it kind of gapped down there. Yeah, that is problematic. It's not holding up the support zone. What's going to be interesting to see is if it's going to go below this area here. Let me just grab the horizontal ray. Yeah, keep in mind, guys, if you're holding tech stocks, if you're holding growth stocks, I'm looking at the NASDAQ right now, like the QQQ that's tracking the NASDAQ. Keep in mind, if this chart is going to look worse the coming days, that would mean all those growth stocks and tech stocks are going to be looking worse. They're going to be going down, most likely, I would say. So I would say a crucial zone is right here at the 312 There is some space, so it could be running a little bit lower. It's allowed to, because I don't. This is not much of a support right here. So, but yeah, we do have two gaps right there. But yeah, if it goes below this level, then I think we're having more of a crash than a correction. I doubt that it's gonna do that, but so yeah, the bounce could be imminent, I would say, but we'll have to look at the daily chart, see what's happening there. Definitely good cross on the daily chart. You can see it right here. It has to hold this area. If it does not hold that area, then what we're gonna see is basically a roughly 10% correction in total. I would say from top to bottom. So we would go back to roughly this area. Hold up. Right around this area right here where we have a small gap. Yeah, that could be a possibility then. Yeah, expect tech stocks to sell off massively if that's the case, though. But I think we're first going to see a rebound, if anything, before that is going to happen. I don't think it's going to go down in one straight line. Generally speaking, you see people buying the dip. With Tesla, oh my gosh, look at that. Tesla's now at 665. Damn. That is interesting. 665. It is getting close to that strong support zone, which is that 655, 650. So we're getting closer and closer to that area. Very oversold right now on Tesla stock. Somebody's saying, what is going on with the markets? Well, basically, what is going on is that money is becoming worthless. Basically, Zimbabwe style. No, I'm kidding. It's not like that, but we're going to get high inflation. And if you think about it, what are stocks that people want to hold when there's high inflation? Basically, you want to be holding commodities. You don't want to be holding tech stocks because the money, the earnings that you're going to be getting, the profits that you're going to be getting are going to be worth less. And I think people are pricing in that down the road, 5 to 10 years from now, we'll have more inflation than we have right now, which means that the companies you're going to be owning are going to be worthless in terms of like the money that they get, the earnings that they have, the profits. It's going to be worth less and less. And that is problematic because your returns are going to be less. And that's what people are worried about right now. That, you know, with growth stocks in particular, if you're going to have inflation, that is just, at some point, they're going to have to also increase interest rates, which is, you know, they're going to have to price that in. If interest rates go up, you will see pretty much companies not being able to borrow for cheap. And if they can't borrow for cheap, well, growth stocks that are in debt right now that don't have enough money to kind of cover the costs, they're all going to go under. So what you're seeing right now, index like the ETF, the ARK ETF right now, which is heavily relying on growth stocks, it's down 5% back to back, like 5% yesterday, 5% today. I warned about this. I said this. Also, I kind of read it from Michael Burry. He pointed this out, and then I did some own research. And basically, growth stocks are now pretty much, if inflation is going to be coming, they're going to be underperforming. Which now you're seeing ARK underperform as well. But we're going to have to see what happens. You know, we haven't seen everything just yet. People are thinking there's going to be a lot of inflation, but that does not necessarily have to be the case. Let's look at Palantir. Back to Tesla, 666 right now. Tesla, damn. Look at that, heavily oversold. 4 hours, heavily oversold. Daily chart, getting to that oversold. I'm so tempted. We got a 10 euro donation coming in from Andrew Porter. Thank you so much, Andrew. You're the best. Appreciate it. I'm gonna have to change my charge my phone right now. Apple is down to, I think Apple's holding up. Several gaps to the upside coming in, so I think Apple will be bouncing back. With Amazon, I think a lot is happening with Amazon right now. It's both the negative news cycle around Amazon, because there's some really, really controversial stuff happening, which is also tanking the stock price, I would say. And let's see. Yeah, so with Amazon, I would say it's just so much, I would say bad luck, generally speaking. Employees are unionizing, which is, to be fair, the conditions in those facilities or faculties, like the places, the warehouse, right? It's not very nice. But yeah, that's having a negative toll on the stock, which is, you can see it right here. It's been going down quite substantially. I guess Jeff Bezos is going to be leaving the company at the right time. What's happening with Tesla? Still down 6.7 percentage points. I am just so tempted to get more Tesla stock, and I think I will be getting some more Tesla stock very soon. I'm going to be buying again at the 650s. So that's going to be like, I'm going to be dollar cost averaging it. Roughly 8 minutes left, guys. 8 minutes left until the markets are going to be open. Elite Kings coming in with a $2 donation. Thank you very much. And he says, do you think Apple and Tesla will be back next month? Yeah, I do think so. I don't think this is going to be a flash crash. I think we're going to see it come back quite robustly. People are panicking right now, but I don't think it's gonna last, because cars are still gonna still be sold. You're gonna see iPhones still gonna be sold. Actually, I think there's gonna be a lot of, I think sales are gonna be just fantastic. So for the terrible quarter that Q1 is, I think it's gonna be relatively mild. Bilibili, can you check Bilibili from Dan Williams? Okay, let me just check that. Yeah, so this is probably another tech, right? So it's tech. I mean, all of tech is selling off. Yeah, the real question is going to be, well, it has a 37 billion market cap. Yeah, we do see this trend line being upheld right here, roughly speaking. So yeah, it could bounce. It definitely could bounce here if the market stabilizes. It's all about the markets right now. The individual stocks don't matter at all if the stock market as a whole is selling off. So we're going to have to wait and see what happens with the market, which I think we're going to see a rebound at least. We haven't seen a rebound yet. Let me check Tesla. There's about 6 minutes left, and Tesla's going down. It is going towards the 663. Oh my gosh, look at that. We're now at 663 on Tesla. I am so tempted to get some more Tesla. It is absolutely nuts. What is happening with NIO? Yeah, NIO is not taking it. We saw a gap to the downside, like with many stocks out there. It's at $45, and let's see. Well, I mean, Tesla's going down. The stock market is going down. Both of these combined is having a very negative impact. But I can admit, I did not expect it to go below the 50s. It's now at 45 right now. Let me check the 4 hours. Heavily oversold. Absolutely insane. So daily chart not oversold yet. It might get to that point. Yeah, it's below. Hold up, let me see. Yeah, it's actually below that trend line as well. And is this a support zone? Yeah, we have earnings coming up. I think with earnings coming up, that might be a very positive influence. So, like, a true support is at the 42. But I would not be surprised if during the open hours we would see NEO come to the upside quite a lot. We do have a major gap right here. So I'll delete this. So I'm not too worried about this. I think it's going to come back since we do have earnings coming up. We have deliveries coming up. Fundamental catalysts. NEO is going down because the markets are going down. But look at that heavy selling though. That is very interesting. Like the Nasdaq is down 2%. You see NEO going down 10%. Tesla's at the 667. 3 more minutes left. Let's see what's happening with CCIV. CCIV is at $36. It went down quite a lot. This is because of the merger announcement. People sold the news, which was very predictable. Very, very predictable, I would say. I said several times on the merger announcement, people will sell off. They're going to wait until the merger. They're going to buy back in. This is generally how it goes with SPACs. Especially if the market cap is so overvalued. 3 more minutes. Palantir at 25.85. Like everything is oversold. That is what we're seeing. And well, not necessarily everything. If you go to like Carnival Corp. Okay, so even Carnival Corp is down. Okay, interesting. What's happening with AAL? AAL is up. Like, so American Airlines is up. Commodities is in general, like the sugar commodities. Yeah, commodities are just flat right now. Oh my. Tesla 662. Just straight up crashing. Yeah. We're in the support area now. So hopefully it rebounds from here. 2 more minutes left, guys. Let me see. The main reason for subscribing to Gara is for the comfort. Give me strength, Gara. Wow, comfort. I mean, if that's the reason you subscribe. Cheers. 661.9. Oh boy. Couple moments left. One more minute until the market opens. I want to see what happens in like on the 5-minute time frame. I want to see what happens here. So it could be dropping much further if people think that this is the end of the growth stock saga, right? So but we're very oversold. So if anything, I personally am expecting a swift rebound the coming hours. Yeah, that's just what I'm expecting right now. Who knows? You know, like it could first crash and then come back up, but still, I think it will be rebounding. Tesla stock in particular. 661.6. 1 more minute. Okay, we got roughly 30 seconds or a couple seconds left. All right, let's see. Come on. And the markets are open. Tesla's falling to the 660s, to the 650s. Now going towards a crucial support level. Hold up. It's now the 666. It's bouncing off. It bounced off the 650s. Like I said, very strong support. And we're seeing it go to the 670s. Or at least it's rallying to the 670s right now. Very interesting. 670s have been reached. Gap's going to be filled probably very soon. Yeah, we're going to the 670s. Come on. No, it's actually seeing a lot of resistance right here. Let's see what's happening with Palantir. Palantir sits at 25. Substantial support right there. It's not going below it, so that's very great. We're now at the 670s on Tesla stock. So we bounced off the 650s, like I said we would, because that was a very nice support level. 672. It's rejecting really hard. It's people are selling at every given opportunity. 674. We're going above those levels. 675. Yeah, that was the dip. I think that was the short-term dip. It might go back there, but I doubt it. We're still very oversold on several time frames. So 675 on Tesla. Very nice. Apple still 123. People do not seem to like it right now. Amazon down 1.4%. NIO is still down, but it's gradually picking up the pace to the upside. XPeng is in a really weird predicament because obviously we have the lockup period expiration happening today, so it's probably happening right now as we speak. But yeah, Tesla's coming back to the 674. Let me see how Tesla's doing on my portfolio. I think it's doing pretty fine. Yeah. But yeah, my portfolio is just down so much right now. Let's see how many percentage points. I'm down about 8 percentage points on my private portfolio, which usually I'm not down that much usually. Hold up. Let me just... hold up. I'm going to be depositing some money on my account so I can buy some stocks. It's going to take a second. Tesla's selling off right now a little bit to the 669. $666. It keeps falling. 668. Richard Brewer coming in with a $5 donation. What do you think of Apex? I think Apex is going down as the Nasdaq is going down. So there's, yeah, I guess that's it. Hold up. 1 second. Yeah, so Tesla's now at 662. I am so tempted to get like so many stocks at the moment. The whole market is still selling off. I got some more Tesla. Let's see where it goes. Let's see. Yeah, the market is still selling off like in a massive way right now. Damn. Ooh. Hold up. $655. Look at that. Oh my gosh. $653. There's just selling pressure, nothing else. 653. It's holding it to 653. Come on. If it doesn't hold that, it's just like gonna go to the 600s. Like for sure. 654, 655. Let's see. Yeah, I'm getting some more Tesla at the 650s. So here we go. That should be fine. But yeah, it's been a rough ride so far. Damn. 657. Palantir is still at the 25 support. Expected that to be happening. Neo is at 44. Look at that, 43. Oh my gosh. I mean, this is happening because if you look at the weekly, it did cross there, like very, very swift. Yeah, look at that, the weekly cross. I did yesterday say that there was two scenarios. Either it doesn't cross and we bounce, or we cross and it just goes all the way to oblivion. Although I personally did not expect it to hit 43. My limit was like the 45. But with the market selling off the way they are, I think anything is possible here. 2.2 percentage points to the downside here. Tesla at 647. Look at that. 647 on Tesla right now. Holy moly. That is insane. Oh. We're at the 650s. Hopefully it holds this level. There's a possibility that it won't, but I doubt it. I do think it will hold. AI is down. Snowflake is down a lot. 250 right now. C3.ai just down 7% again. So back to back, the whole tech sector selling off here. Woof. This is very bloody. Very bloody indeed. Let's see. Let me see. Let me see. Xpeng is down. That's a lot of loss. 14% since I bought. Palantir is down roughly. Let's see. Tesla hitting 643. Going to the 640s now. Going back to the 650s. Let's see. Palantir, getting close to 24. Getting very close to 24. Xpeng is holding up, I would say. It filled the gap recently, right at that 34, 35. We have AI, C3.ai, still not bouncing back. Going lower as the Nasdaq is going lower. Same story with Snowflake. Holy moly, this is one really bloody sell-off. As these stocks are correcting like in a very significant way. Look at that. NEO is down 17 percentage points. Look at that. Institutions are selling like crazy. Are they? Hold up. Let me check the 30. Yeah, this is institutional selling, I would say, partially. Nah, it's I would say it's a mix of institutions and retail. The volume is not that high, but it's definitely higher than usual. Living in some interesting times right now. Like this is just Tesla is down to 636 right now. $639. Oof. Let's see. $6.30s coming in. What a huge sell-off. This is just very brutal. A lot of people have bought Tesla stock at like $800, $850s, $880s. Look at that, $6.30s. And it doesn't stop. The bleeding does not stop. It is going down all right. Whew. It is one bloody sell-off. $6.34, still not bouncing. This is like a falling knife. I mean, a falling knife at this point. Let's see, go back to... I still do not think that this is bad. I still think that these prices that we're seeing, if anything, they're buying opportunities. Institutions, I think investors alike are going to be buying these dips. Snowflake at 240, C3.ai at 110. Palantir now below the 25. Yeah, we're seeing some significant signs. This is the watch list that we're covering, right? What is happening with the banks? Are the banks still performing? JP Morgan. Look at that, casually going up a percentage points. Meanwhile, all of tech is just selling off. So, let's check Goldman. Very interesting. I guess Goldman is going down a bit. Tesla's coming back up from the 630s. But still down 10.7 percentage points. Look at that MACD just dropping off a cliff. When was the last time we saw such a significant downturn? I don't think anybody could recall that. Let me see. Oh boy, what is happening? What is happening is we're seeing a rotation happen from just tech stocks, right? Tech stocks, growth stocks, money's going back into, I would say, value stocks, right? So with like companies that have great balance sheets, they're going to be performing very good. We're now at the 630s on Tesla stock, and the bleeding has not stopped yet. I would say it's not even close to stopping. Let's put it that way. Uh, 631.5. What is happening with CCIV? CCIV is at $32. Whoa, look at that. 44 point... Yeah, market cap of 8.7 billion. Still very overvalued, I would say. it's still... I mean, it could... I think it's going to rebound very soon, but still. Tesla at 626, 628. Look at that. Still falling off. Oh my gosh. This is so bloody. This is like next level. Let's see. $6.33. This is definitely a support zone. This is definitely a support zone. So, if anything, this is going to be rebounding fair. Like, that's what I've been saying, right? 650 broke through, 630 broke through, 620. Let's see if it's going to hold. This is not like March. This is not like March. I do not think this is like March. It doesn't even look close to it. March was absolutely terrible. You do not remember March last year, 2020, if you think this is March. This is not March. We had, like, I think at some point Tesla was down like 20% in a day or something like that. This is getting close, but still. We're at high. This is at high valuation. Tesla went down at low valuations. $620 has been reached. Look at that. $620. Oof. Let's see. Double down. I got some at 620, 624. Oh my god, look at that. I am just speechless of what is happening right now. It's just absolutely nuts. Let's see. We saw it correct roughly, I think 30% now. So Tesla's down 30% from the top to the bottom. Let's see if it's going to give back more. But the funny thing is, yeah, now actually the S&P is also coming down now. Like, everything is coming down as we speak. This is the correction. Yeah, this is definitely the market correction. Look at that. So we had a 5% correction. Now we have another roughly, what is this? 3% correction coming in on the whole market. Which is to be fair, I mean, we are at the stock market as a whole is at rich valuations, so I don't think that is too surprising. But still. People are saying this is not over yet. I mean, I don't know. Xpeng at 32. Holy moly. Man, that is just brutal. That is just absolutely brutal. Let's see. That is just, I would say, that is just nasty. I mean, Xpeng is having a lockup period expiration on top of what is happening. But for some reason, NIO is down more than Xpeng. But it's just mind-blowing. Palantir 24.7. Tesla at 627. Still not rebounding there. Still very, very oversold. So anybody with cash right now is having a good time. Cash is king. I still have some cash left, but I already bought the dip several times. Got my average price on Tesla to roughly 650, but it's, yeah, I mean 650 is still pretty high considering it was at 620 at some point. Let's see what's happening here. $634.9 on Tesla at the moment. 635. It's coming back up. This is a similar downturn to what we saw right here. From $500 to $340, roughly that. Similar downturn. This is very similar in terms of the size of the downturn. So, and it should be able to pick up pace. It even looks quite similar in the structure of the price. Although I have to say, back then we did see like a lot more negativity, but this time around we have the S&P inclusion priced in. So yeah, we could see, I think we could definitely see it go back up quite substantially here on any kind of rebound. Yeah, we properly went down on the weekly, all right. That was absolutely bloody. Weekly is just going to neutral. It's not even... This is kind of similar to the March downturn in terms of like momentum. Yeah. Yeah, we had a 60% correction back then. It was absolutely nuts. It's going to 640 right now as we speak. Let's see what's happening here. Hmm. 642. Yeah, it's coming back up. Palantir coming back up as well, I would say. Yep, pretty much. Yeah, this might also be the, like, I think there are several factors right now why this is happening right now, right here. Let's see what's happening in the live chat. I cannot read the live chat right now because it's going so fast. CCIV at $32. Look at that. It's 32. What is happening with ARK? ARK should be like down 6%. It's down 8.8 percentage points. At some point, it was down 10 percentage points, right? It was down way more. Look at that. That is ARK for you right now. This is value. When a stock doesn't have enough value, that's what... When you invest in stocks that only are labeled as growth stocks, then you'll see high downturns, like really, really significant downturns when the markets go down. Which makes a lot of sense, right? So let's see. Yeah, so ARK is like having a rough time right now. Tesla coming back up to the 645. Palantir coming back up to the 25. Everything is sort of gradually recovering right now. NEO as well, although it did reach 41.5 at some point. Imagine buying NEO at 42. Imagine buying Tesla at 645, 620. Imagine buying XPeng at 32. That's what a lot of investors are doing right now. They're buying the dip, right? It's dollar cost averaging every couple percentage points, buying a small amount, getting your costs lower, your average cost. That is the strategy. This shows you going all in just does not make sense, because a lot of people do that. They go in like with huge amounts, and it's just like, what are you doing? Like, doesn't make sense. DCA beats everything, pretty much. Shows you again. Tesla going up to the 650s, or at least it's going to try to. I don't think Elon Musk is the richest man alive anymore. Not by a long shot at this point. But yeah. We're now at the 650s on Tesla. Palantir 25.6. Everything is coming back up. That was one swift, I would say, downturn. Look at that. NASDAQ came all the way to this support. Like I said, it was going to bounce off that support. It did. Went below it a little bit, but it bounced off. Hopefully, we can consolidate here and then gradually fill that gap. We'll see what happens. What's happening with Morgan Stanley? It's only down 0.8%. So value stocks right now are performing very, very good. Like, exceptionally good. Powell is about to speak. Yeah, that is true. Jerome Powell is about to speak. Danny coming in with a €2 donation. What is good buying opportunity for a swing trade? Well, I can't give financial advice, but what I can say is that yeah, most of the buying opportunities were already made at the 620s on Tesla. XPeng was at 32. You had NEO at 42. Apple at 118 for a second. Tesla's coming back very strong now. I think C3.ai is still looking sweet at 114. I think people didn't pick up on that one. I think at this point, Snowflake at 25 points, I would say 250, looking good for earnings. Personally, I think those are... NEO is looking quite strong right now at the 45, of course. I mean, after that massive downturn with institutions selling after selling after selling. Keep in mind, most of the shareholders on NEO are institutions. Yeah, so it's been a rough patch. But yeah, Tesla coming back up. Let me check. Oh, wow. Let me think about this. Palantir 25.5. Yeah, I guess it's just the patience game, right? You gotta have some patience. Patience is gonna be paying off big time, so that's all I can say about that. Let me check what's happening with Tesla. Yeah, I think Palantir is going to be coming back up. Everything is going to be coming back up right now. We see the stock market sort of recovering at this moment. Oh, Powell is speaking right now. Yeah, that could be the case. I do remember. One moment. Let me just check if I can find him at the moment. Hold up. Chris Jimenez coming in with a $5 donation. Thank you so much, Chris. My man, let me know what you think of Neo, please. Sure thing. Hold up. Let me check out Jerome Powell live. I don't think he's live yet, is he? He's going to be live in a couple minutes. Hold up. I'll let you guys know if he's live, because he's going to be live in a couple minutes, I believe. And we're going to be watching that together. Still waiting on that, on the footage. Wait, let's... Alright, so it's going to be live any moment now. At least CNBC says that. Let me just fix the video cam in a second. So if you guys don't know, the Federal Reserve Chairman Jerome Powell is going to be speaking. And that will be quite important, I would say. Just fix the camera. I think that should be fine. He could already be speaking at this point. It's just I'm gonna have to refresh it. Should be right now. Jerome Powell live. Come on. That's right here.
Before D-Day, General Eisenhower didn't call President Roosevelt and ask, can we afford to storm the beaches at Normandy? Do we have the money in our accounts? Most people that I talk to in Ohio and around the country are not worried about doing too much in the battle against this virus. They're worried about doing too little. They want to do whatever it takes. 85% of Americans still need a vaccine. Our frontline workers still need PPE. Small businesses still need assistance to keep their doors open. States and cities and towns still need resources and support to open schools safely and keep buses running and libraries open and firefighters on the job. Experts agree the best thing we can do for the country right now is to get resources out the door as quickly as possible to tackle these interconnected problems. Former Fed Chair, now our Treasury Secretary, Janet Yellen, said if we don't do more, we risk a permanent, her words, scarring of the economy into the future. Economists from across the political spectrum, include many who have testified before this committee, tell us that without strong fiscal support, our economy could spiral even further out of control and take even longer, years to recover. Our witness today, Federal Reserve Board Chair Jerome Powell, expressed some of those same concerns. Just a few weeks ago, after we passed the COVID-19 relief bill in December, Chair Powell said that, quote, support from fiscal policy will help households and businesses weather the downturn as well as limit lasting damage to the economy that could otherwise impede the recovery. Chair Powell has talked to all of us about the risk of falling short of a complete recovery, the damage it will do to people's lives and to the productive capacity of this economy. Those were his words, productive capacity of this economy. President Biden understands this moment. He's risen to meet it with his bold American Rescue Package. It's a plan to both rescue the economy and save American lives. Workers and their families need to see their government work for them now. And this rescue plan must be the beginning of our work to deliver the results that empower people and make their lives better. We need to rethink how our economy operates when a hard day's work doesn't pay the bills for tens and tens of millions of workers. And even middle-class families don't feel stable. Something in the system's broken. We know that. Workers' wages have been stagnant for decades. CEO pay has soared. Corporations get huge tax break. Instead of investing in their employees and the communities they serve, management too often rewards itself and its shareholders through stock buybacks and dividends. The wealth and income gaps for women and for Black and brown workers are getting worse, not better. Many families still had not recovered from the Great Recession when the pandemic hit. This didn't happen by accident. It's the result of choices made by corporations and their loyal allies in Washington. They spent years rolling back consumer protections in our financial system, cutting corporate tax rates, using Wall Street to measure the economy instead of the condition of workers. And the same people that have been advocating for these rollbacks, pushing this stock market-centered view of the economy, are the same people who say we should not go big on a rescue plan. They say there's no need for the government to help people, that the market should decide who wins and who loses. We all know the market doesn't work when the game is rigged. Corporations have been lining their own pockets, have done so with plenty of government help and intervention. We know that for them, short-term profits are more important too often than their workers. That's why we have to stop letting them run things. Look what's happened in Texas, where a deregulated energy grid failed, leaving millions without power in frigid winter temperatures. People are literally freezing to death in their own homes in the United States of America. Without any rules, energy companies can charge consumers sky-high prices. They even use automatic debits, taking thousands of dollars directly out of people's bank accounts. We know climate change causes severe weather patterns across this country. We know more investment in public infrastructure, not less. We need more, not less. We can't let corporate greed continue to stand in the way. Our nation's central bank plays a critical role in all of this. The Federal Reserve can ensure the biggest banks use their capital to invest in their workers and lend in their communities instead of ginning up stock prices with buybacks and dividends. The Fed can make sure the response to economic and financial crises doesn't just help Wall Street, it helps everyone. It can require that financial institutions take into account the serious risk posed by climate crisis. It can help ensure that everyone in this country has a bank account and access to their own hard-earned money. It can start to undo the systemic racism in the financial system, from black codes to Jim Crow to redlining to locking in discriminatory practices during the last administration. It can make workers the central focus of our economy. Chair Powell, you said just a few weeks ago, quote, "The benefits of investing in our nation's workforce are immense. Steady employment provides more than a regular paycheck. It bestows a sense of purpose. It improves mental health, increases lifespans, benefits workers and their families." Unquote from the chair. What that boils down to is the dignity of work. It means hard work should pay off no matter who you are, no matter what kind of work you do, whether you punch a clock or work for tips or work on a salary or taking care of aging parents. It means we need to start measuring success of our community by the success of the people who make our economy work. Chair Powell, thank you. I look forward to your testimony. Senator Toomey.
Let's go.
Thank you, Mr. Chairman, and thank you, Chairman Powell. Welcome back to the Banking Committee. I look forward to your testimony. About a year ago, the U.S. economy was entering an unprecedented economic contraction as a result of the shutdowns that followed the spread of COVID-19. We all remember credit markets seizing up. Second quarter GDP last year fell by over 30%. Unemployment rate reached about 15% in April, the highest it had been since the 1930s. The economy was in very desperate straits, to say the least. Thankfully, the worries about a long, drawn-out depression appear to have been unfounded. In response to the economic collapse, Congress and the Fed took very, very bold, unprecedented, and decisive action. The Fed quickly lowered interest rates, launched a quantitative easing program on an unprecedented scale, and helped facilitate market functioning through a variety of emergency programs that were funded through congressional legislation. And we in Congress passed over $4 trillion in relief over 5 overwhelmingly bipartisan bills. Fortunately, today, we are in nothing like the situation we were in last spring. Today, the unemployment rate is now 6.3%, about where it was in July of 2014. 18 states have unemployment rates below 5%. The average household in America is in a better financial position today than it was in before the pandemic. Personal savings rates are up by over $1.6 trillion. Consumer credit is down by over $100 billion. There's no question there are some subsets of our economy and our society that have been hit much harder than others. But in the aggregate, the fact is Americans have more disposable income now than they had before the crisis. And yet, Congress is in deliberations to spend another $1.9 trillion with universal payments to people who've never had as much income as they do, to entities that have such as state and local governments, which in the aggregate have taken in more revenue in 2020 than they did ever before. We are well past the point where our economy is collapsing. And in fact, our economy is growing very powerfully. The last thing we need is a massive multi-trillion-dollar universal spending bill. And we should recognize that all of this spending comes at a cost. It all gets funded with government debt, which is either monetized, which has its own dangers, or it's a burden that gets passed on to future generations that have to service that debt. In 2020, debt held by the public reached 100% of our total economic output, and CBO projects that over the next 10 years, net interest costs will amount to $4.5 trillion, and that's without another $1.9 trillion bill. There's also a real danger that we have overheating in places that lead to unwanted inflation, and I think the data is increasingly pointing in that direction. Keep in mind, we have $11 trillion in personal saving deposits. The country is in an accelerating reopening as the number of COVID cases is declining very, very rapidly on a daily basis. The economy is poised for very substantial growth in the near term, and yet the Fed continues to purchase $120 billion of securities per month, maintain short-term interest rates at basically zero, and Congress is considering, as I said, another enormous bill. And another matter, I want to make the point that I do think it's very important for the Fed to continue focused on the mandate it has and not to seek to broaden that mandate. As noble as the goals might be, issues such as climate change and racial inequality are simply not the purview of our central bank. So during this hearing, I look forward to hearing about your views, Mr. Chairman, on the economy, on monetary policy, and the state of our markets. And with that, I yield.
Thank you, Senator Toomey. Today, we'll hear from Federal Reserve Chair Jerome Powell on the Fed's monetary policy and the state of the U.S. economy. It's nearly 1 year since the coronavirus pandemic first wreaked havoc in our country. We know the Federal Reserve plays a key role in making sure that our economy recovers for all Americans. Chair Powell, thank you for your service. Thank you for being in front of our committee today and for your testimony. Proceed.
Thank you and good morning. Chairman Brown, Ranking Member Toomey, and other members of the committee, I'm pleased to present the Federal Reserve's semi-annual monetary policy report. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Since the beginning of the pandemic, we've taken forceful actions to provide support and stability, to ensure that the recovery will be as strong as possible, and to limit lasting damage to households, businesses, and communities. Today, I will review the current economic situation before turning to monetary policy. The path of the economy continues to depend significantly on the course of the virus and the measures undertaken to control its spread. The resurgence in COVID-19 cases, hospitalizations, and deaths in recent months is causing great hardship for millions of Americans and is weighing on economic activity and job creation. Following a sharp rebound in economic activity last summer, momentum slowed substantially, with the weakness concentrated in the sectors most adversely affected by the resurgence of the virus. In recent weeks, the number of new cases and hospitalizations has been falling, and ongoing vaccinations offer hope for a return to more normal conditions later this year. However, the economic recovery remains uneven and far from complete, and the path ahead is highly uncertain. Household spending on services remains low, especially in sectors that typically require people to gather closely, including leisure and hospitality. In contrast, household spending on goods picked up encouragingly in January after moderating late last year. The housing sector has more than fully recovered from the downturn, while business investment and manufacturing production have also picked up. The overall recovery in economic activity since last spring is due in part to unprecedented fiscal and monetary actions, which have provided essential support to many households, businesses, and communities. As with overall economic activity, the pace of improvement in the labor market has slowed. Over the 3 months ending in January, employment rose at an average monthly rate of only 29,000. Continued progress in many industries has been tempered by significant losses in industries such as leisure and hospitality, where the resurgence in the virus and increased social distancing have weighed further on activity. The unemployment rate remained elevated at 6.3% in January, and participation in the labor market is notably below pre-pandemic levels. Although there has been much progress in the labor market since the spring, millions of Americans remain out of work. As discussed in the February Monetary Policy Report, the economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden has been hardest hit. In particular, the high level of joblessness has been especially severe for lower wage workers and for African Americans, Hispanics, and other minority groups. The economic dislocation has upended many lives and created great uncertainty about the future. The pandemic has also left a significant imprint on inflation. Following large declines in the spring, consumer prices partially rebounded over the rest of last year. However, for some of the sectors that have been most adversely affected by the pandemic, prices remain particularly soft. Overall, on a 12-month basis, inflation remains below our 2% longer-run objective. While we should not underestimate the challenges we currently face, developments point to an improved outlook for later this year. In particular, ongoing progress in vaccinations should help speed the return to normal activities. In the meantime, we should continue to follow the advice of health experts to observe social distancing measures and wear masks. I'll turn now to monetary policy. In the second half of the year, the Federal Open Market Committee completed our first ever public review of our monetary policy strategy, tools, and communication practices. We undertook this review because the U.S. economy has changed in ways that matter for monetary policy. The review's purpose was to identify improvements to our policy framework that could enhance our ability to achieve our maximum employment and price stability objectives. The review involved extensive outreach to a broad range of people and groups, including through a series of Fed Listens events. As described in the February Monetary Policy Report, in August, the committee unanimously adopted its revised statement on longer-run goals and monetary policy strategy. Our revised statement shares many features with its predecessor. For example, we have not changed our 2% longer-run inflation goal. However, we did make some key changes. Regarding our employment goal, we emphasized that maximum employment is a broad and inclusive goal. This change reflects our appreciation for the benefits of a strong labor market, particularly for low and moderate income communities. In addition, we state that our policy decisions will be informed by our assessments of shortfalls of employment from its maximum level, rather than by deviations from its maximum level. This change means that we will not tighten monetary policy solely in response to a strong labor market. Regarding our price stability goal, we state that we will seek to achieve inflation that averages 2% over time. This means that following periods when inflation has been running below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. With this change, we aim to keep longer-term inflation expectations well anchored at our 2% goal. Well-anchored inflation expectations enhance our ability to meet both our employment and inflation goals, particularly in the current low interest rate environment, in which our main policy tool is likely to be more frequently constrained by the lower bound. We've implemented our new framework by forcefully deploying our policy tools. As noted in our January policy statement, we expect that it will be appropriate to maintain the current accommodative target range of the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment. and inflation has risen to 2% and is on track to moderately exceed 2% for some time. In addition, we will continue to increase our holdings of Treasury securities and agency mortgage-backed securities, at least at their current pace, until substantial further progress has been made toward our goals. These purchases and the associated increase in the Federal Reserve's balance sheet have materially eased financial conditions and are providing substantial support to the economy. The economy is a long way from our employment and inflation goals, and it is likely to take some time for substantial further progress to be achieved. We will continue to clearly communicate our assessment of progress toward our goals well in advance of any change in the pace of purchases. Since the onset of the pandemic, the Federal Reserve has been taking actions to more directly support the flow of credit in the economy, deploying our emergency lending powers to an unprecedented extent, enabled in large part by financial backing and support from Congress and the Treasury. Although the CARES Act facilities are no longer open to new activity, our other facilities remain in place. We understand that our actions affect households, businesses, and communities across the country. Everything we do is in service to our public mission. We're committed to using our full range of tools to support the economy and to help ensure that the recovery from this difficult period will be as robust as possible. Thank you. I'm happy to take your questions.
Thank you, Chair Powell. First, just a yes or no question. Do you agree the most important thing we can do for the economy right now is get people vaccinated?
I would say that yes, that is the single best policy to return the economy to its potential growth.
Thank you. The researchers in Minneapolis Fed say the pandemic is forcing mothers of young children out of the workforce. Some 3 million women have been forced out of the paid labor market in the past year. Everyday families face impossible choices between their paychecks and caring for their children. The Biden Rescue Plan, as you know, provides the funding we need to get Americans vaccinated, as you suggest is the right policy. And that will help kids go back to school, to help working moms back to work, get back to work safely. What can the Fed do to make sure women, especially those with young children, can return to the workforce so that we don't end up with an even bigger lasting gender gap in the labor market?
So the tools that can really address specific groups, for example, women who've perhaps temporarily dropped out of the labor force, those are really fiscal policy tools. Obviously, those are not tools that we have. And I today will stay away from fiscal policy and really talk about what we can do. And I think the main thing that we can do is continue to support the economy, give it the support that it needs. We're still 10 million jobs below the level of payroll jobs before the crisis. There's still a long way to go to full recovery, and we intend to keep our policy supportive of that recovery.
Thank you for acknowledging in your opening statement and your comments to many of us and for your public comments, frankly, about how much we need to do to fight racism and increase diversity. Yeah, we know historically the Fed's monetary policy has benefited wealthy savers and homeowners. Decades of discrimination in the financial system we talked about earlier, from redlining to the subprime mortgage crisis, specifically targeted Black, Brown, and other vulnerable communities. It's clear the Fed's policy and failure to regulate predatory actions in the banking sector have contributed to the racial wealth, income, and home ownership gaps. You've said that the Fed's tools can't address the underlying causes of racial injustice or income and wealth inequality in our economy. I think you give up a little too easily when you say that. So how can the Fed use its supervision authority to enforce anti-discrimination laws and fight racial injustice and income inequality?
We do have responsibilities and authorities for fair lending, for example, under a number of statutes, and we take those responsibilities very seriously and I think carry them out robustly, and that is an important part of our mandate. And so that is something that we can do, and I think we do aggressively. In addition, through our community and consumer affairs division and through the Federal Reserve banks, we don't spend public resources, but we try to attract private resources around, for example, initiatives that will address issues of economic issues of low and moderate income communities and racial minorities.
I think we can do more, but we will discuss that later. Chair Powell, in the middle of the pandemic, bank regulators have loosened capital requirements at the biggest banks. And one of its changes to the capital rules, the Fed stated the rule was meant, and I quote, to allow banking organizations to expand their balance sheets as appropriate to continue to serve as financial intermediaries rather than to allow banking organizations to increase capital distributions, unquote. In other words, the Fed reduced capital standards so banks would lend more, not so they would pay dividends. But it's, as you know, it's not what's happening. The biggest banks have gotten larger. They've gotten more profitable, but they haven't increased lending. Dividends, however, have remained steady. My question is, Mr. Chair, will you promise to the committee that you will not extend any exemptions for capital requirements for banks and bank holding companies that have continued to pay dividends rather than invest in the real economy?
So we're talking here really about the temporary measures we took with respect to the supplemental leverage ratio, and those expire at the end of March. We have not decided what to do there yet, and we're actually looking into that right now. I'm not going to commit to connecting that decision to the payment of dividends as a separate matter. As you know, we intervened to require the banks to limit their dividend growth to zero and also to limit their share buybacks. And the result, what you see now, is a banking system that has higher capital than it did going into the pandemic, and particularly for the largest banks, and one where the banks have taken very large reserves against losses, and so have proven themselves pretty resilient.
Perhaps, but I also we also understand that they have not been supporting the real economy to the degree that we hope they would, and we will continue that conversation. And I will send a written question to you on climate that we wanted to talk about. Senator Toomey.
Thank you, Mr. Chairman. Just on this topic, let me just state I certainly hope that to the extent that banks have adequate capital for the circumstances that they face at any point in time, any capital beyond that should absolutely be available to be returned to the people who own those banks in the form of dividends or stock buybacks or whatever mechanism is suitable. And anything to the contrary is a terrible constraint on our economy and on economic freedom. I also want to just observe briefly, and I'm not asking for a comment on this, Chairman Powell, but if I could summarize and characterize your opening comments about the economy, I think it's fair to say that we have many areas, sectors of our economy that are performing extremely well. Housing and the goods sector, I think you referred to. And then we have very concentrated problems in certain relatively narrow sectors like hospitality and travel and entertainment, which are extremely depressed because of the circumstances. I think that clearly makes a very strong case that if there were to be further fiscal policy, it should address where the problem is and not where the problem is not. But to address monetary policy for a moment or so, I think the Fed's current forecast for growth for this year is over 4%. I think the consensus is well over 5%, with some thinking it could be considerably higher than that. The unemployment rate is now at 6.3, which is about where it was in 2014 when we were not contemplating multi-trillion-dollar bills. And I don't think we were buying $120 billion worth of securities per month. My concern is that the last two recessions were, I think, caused by asset bubbles that burst. 2001, it was the stock market. 2008, it was the mortgage credit market. In both cases, in my view, monetary policy contributed a great deal to the formation of those bubbles. The Dallas Fed president, Robert Kaplan, recently acknowledged that there's a link between the record amount of liquidity being pushed into the system and these unprecedented asset valuations that we're seeing in a whole range of assets, be it GameStop or Bitcoin or real estate, commodities. Across the board, we're seeing quite elevated asset prices and signs of emerging inflation. So I guess my question is, do you believe that there is a link between the liquidity that the Fed has been providing and some of these unprecedented asset prices?
So there's certainly a link. I would say, though, that if you look at what the market is looking at, what markets are looking at, it's a reopening economy with vaccination, it's fiscal stimulus, it's highly accommodative monetary policy, it's savings accumulated on people's balance sheets, it's expectations of much higher corporate profits, which matters a lot for the equity market. So there are many factors that are contributing to to what's happening in markets right now. Monetary policy, I would certainly agree, is one of them.
Yeah, I would just suggest that, right, I agree. All of those things are happening. All of those indicators of growth and increasingly indicators of rising inflation. As you know, the TIPS 10-year break even on inflation is now over 2%, up from 0.6%. My point is that at some point, we've got too much liquidity going into the system. The economy is recovering very, very well. Problems are isolated and should be addressed narrowly. And I hope that $120 billion a month of bond buying doesn't become a permanent situation. One of the things I'm concerned about, I wonder if you could comment on, the risk that we would have an increase in inflation, an increase in bond yields that would correspond to that, but without being back at full employment. What would that imply, which I think is a very plausible scenario for later this year? What does that imply for the bond buying program?
Well, so what we said about the bond buying program is that it will continue at the current pace, at least at the current pace, until we make substantial further progress toward our goals. And we've also said that as we monitor that progress, we'll communicate well in advance of any actual decisions, purchases. And so that's what it will take for us to begin to moderate the level of purchases. It's substantial further progress toward our goals, which we haven't really been making for the last 3 months, but expectations are that will pick up as the pandemic subsides.
All right.
Well, thank you, Mr. Chairman. I would just suggest that there are a lot of warning signs that have not been worrisome in the past, but now are certainly blinking yellow. And with that, I will yield.
Thank you, Senator Menendez.
Thank you, Mr. Chairman. Chairman Powell, at the end of this pandemic, we need to ensure that we have a more equal society. Unfortunately, we're not on a path to an equal recovery. As of January, the Black unemployment rate is 9.2%. The Hispanic unemployment rate is 8.6% compared to 5.7% for white workers. According to the New York Fed, over the course of the pandemic, the black labor force exit rate has increased dramatically, while the white labor force exit rate has returned to pre-pandemic levels. Doesn't this mean that the black unemployment rate is likely misleadingly low compared to the white rate?
Well, this, as you point out, this pandemic was particularly bad for these long-standing disparities that we have in our economy. The job losses were heavily concentrated in public-facing service sector jobs. Those tend to be more skewed towards lower-paid and in many cases minorities and women. And so that's really where the big pockets of unemployment were made. And so, and you're right. So the burden really has fallen more in the low and moderate income communities than would typically be the case. It's always the case to some extent. This particular event, though, is very somehow precisely aimed at those people, and we're well aware of that.
Well, I appreciate that acknowledgement. We know from the Bureau of Labor Statistics that over the course of 2020, the labor force participation rate for black men and women fell nearly twice as much as it did for white men and women. So you agree that minority families are bearing the brunt of the damage caused by the pandemic?
Yes, along with others at the lower end of the income spectrum, bottom quartile.
Would you agree then that addressing this disproportionate damage needs to be a central priority in relief efforts?
I would have thought so.
Yeah, so would I. Now, as part of the Federal Reserve's mission to ensure maximum employment, what's the Federal Reserve's plan for maximizing employment for low-income and minority workers?
So we look, when we say that maximum employment is a broad and inclusive goal, that means we look not just at the headline numbers, we also look at different groups, and we try to take all of that into account in making our assessment. So we will take into account the headline numbers, but also those for other groups as we think about reaching maximum employment.
Well, I hope that in your mission that the Federal Reserve looks at this, because a Federal Reserve study showed that while high-income jobs mostly recovered to pre-pandemic levels, unemployment among low-wage workers remains 14% below pre-pandemic levels. And this is in spite of the fact that almost half of all low-wage workers are essential workers, the people who actually let us stay home when we were told stay home to avoid the spread of the pandemic and to be infected, but they were risking their lives in the jobs that they did. And so I believe we have the tools and what we to try to make this an equitable recovery. So would you commit to working with Congress and the Treasury to help low-wage workers and minority workers be able to recover just as strongly as others?
We will do that. I will say, though, that monetary policy as a tool is famously it's a broadly effective tool. It doesn't enable us to target particular groups. It lifts the entire economy. But we're going to be mindful, though, of the disparities that exist as we make our decisions.
Then finally, as of February 1st, an estimated 13 million adults were not caught up on their rent. Another 10 million adults were not caught up on their mortgage payments. Our country is very clearly in the midst of a housing crisis. What would be the effect on the housing market and our overall economy if Congress doesn't provide additional resources to help families struggling to pay their rent and mortgages?
Well, if those people, if it were to get to the point at which people were evicted, then you're talking about people's lives being disrupted in ways that are sometimes quite hard to recover from, both for renters and owners. So it is important. I think the single best thing we can do about that, of course, is to keep monetary policy accommodative, to do what we can to speed the recovery so that it will be robust and complete as soon as possible.
Well, millions of people losing their homes would it not only affect rateable basis and the most single aspect of wealth. So I hope you'll keep your eye on that. Thank you, Mr. Chairman.
Thank you.
Senator Shelby.
Good morning. Chairman Powell, thank you for your service of a number of years and how you, I believe, done an outstanding job as chairman of the Federal Reserve. I would like to associate myself this morning with a lot of the questions that have been asked already by Senator Toomey, the concern of inflation, the concern of the balance sheet, where is the economy going when we get over this COVID, which we all hope and pray will be sooner than later. And I'd like to add to that, Mr. Chairman, what's your view of the world economy tying into ours, because it's an important factor as we go forward, assuming in the next, say, 6 months that we get a handle around COVID in the country and Europe, for example, does the same thing.
So I'll take those one at a time. On inflation, let me say that we do expect that as the couple of things. First, as the very low readings of last March and April drop out of the 12-month calculation as we move forward this year, we expect readings on inflation to move up. That's called base effects. That'll be a temporary effect, and it won't really signal anything. More importantly, though, with all the factors we've been discussing, you could see spending pick up pretty substantially in the second half of the year. And that would be a good thing, of course, but it could also put upward pressure on prices. And I would just say that essentially it doesn't seem likely that would result in very large increases or that they would be persistent. We've all been living in a world for a quarter of a century and more where all of the pressures were disinflationary, pushing downward on inflation. We've averaged less than 2% inflation for more than the last 25 years. Inflation dynamics do change over time, but they don't change on a dime. And so we don't really see how a burst of fiscal support or spending that doesn't last for many years would actually change those inflation dynamics. I will also say there's forecasters need to be humble and have a great deal to be humble about, frankly. But so if it does turn out that unwanted inflation pressures arise and they're persistent, then we have the tools to deal with that, and we will. Shall I continue? So on the balance sheet, we're going to continue to. We're at a stage where with 10 million people, payroll employment is 10 million below where it was before the pandemic. We're a long way from maximum employment. We're going to keep the balance sheet's going to continue to provide the support that we think the economy needs. Over time, the growth of it will slow, but that decision is the one that we talked about earlier, where asset purchases will continue until we make significant further progress toward our goals. You ask about the U.S. economy and the world economy. I do think, and many forecasters agree, that once we get this pandemic under control, we could be getting through this much more quickly than we had feared. And that would be terrific. But it's not done yet. The job is not done. That's the thing I keep coming back to, is we've got to finish the job with the pandemic, get it under control so that the U.S. economy can really reopen. Other countries around the world have the same set of issues. But there is, people will get vaccinated and we can get the disease under control properly. The second half of this year and thereafter, the economy could be very good, and could be good elsewhere in the world as well.
Has the fact that the savings rate has gone up tremendously in America, does that bode well in the future as far as perhaps economic activity?
So a lot of that just is that people have not been able to spend. They haven't been able to travel, go to restaurants, and that. So it's kind of forced savings in a way. So they'll spend some of that going forward. You're really thinking, I think, about the fact that the U.S. needs more savings so that it'll have more investment and more productivity. It would be nice if we had a higher savings rate, and it would be also nice if we didn't have a lot of dis-savings at the federal level. That's a lot of it is that these budget deficits require a lot of assets. Not that that's something we need to turn to again, but I think this is not the time to be thinking about that. But that time will certainly come.
Thank you, sir.
Thank you. Thank you, Senator.
Thank you, Senator Shelby. Senator Tester.
Yeah, thank you, Mr. Chairman. And I want to start by thanking Chairman Powell. I very much appreciate your frankness. I very much appreciate your fight to keep the Fed independent. I know that's been difficult over the past number of years, but you've stepped up. You certainly don't want a bunch of politicians determine monetary policy. And so I'm glad you're at the helm. I also think that we're going to have a debate over this $1.9 trillion package in front of you on probably every damn committee that I'm on, and a bunch of others. Some of that all of it is necessary, but I do want to talk to you because everybody makes points that I go, yeah, that's a good point. And it's true. The housing market in a place like Montana is hotter than hot. It is quite frankly booming. And there's another problem that I want to talk to you a little bit about, the housing thing. But there are other industries and there are folks out there who, quite frankly, don't have the job they used to have and may never get that job back. And there are business people out there that are up against it. Some of those businesses will go broke and never reopen. Others will. I just kind of want to get your perspective on, if you were not the head of the Fed, but in the United States Senate, where would you pay most of your attention to? And because I agree, any money we spend needs to be focused where it'll do the most good. There's no doubt about that. Where is your focus? Where would your focus be? Would it be unemployment? Would it be hospitality businesses? Or would it be something more global than that?
It's an interesting question. Again, maybe the grass is always greener, but so our work really relates to managing the business cycle in a way. But what I always think I would focus on is more what we call the supply side, which is really investing in things that will increase the potential growth rate of the United States economy over time and make that prosperity as broadly spread as possible. Now, so let me be more specific. It amounts to investing in people And that means education, it means training, it means all those things. And that enables those people to take part fully in our great economy. And I really do think in a global economy, people who are able to use and benefit from technology, there's no limit on the amount of those people who can be working in the United States because it's such a global economy. I also think it's important for businesses as well that they have a climate where they can trust, that inflation is going to be under control and that business conditions are going to be good and that they can invest in. And I think the federal government investing in basic science over time has produced a lot of productivity enhancing things. But more generally, Senator, I think focusing on things that will make a longer run difference to our economy is what I would do.
Okay, appreciate that. Now I want to go to housing because I talk about Montana, but I think this is true all over. We don't have enough affordable housing. We don't have enough workforce housing. I think that short-term and long-term, by the way, this is going to be a drag on the economy. Do you see the Fed playing any role, or do you think they could have a role in increasing the amount of affordable housing that's out there? And if you do think the Fed plays a role, what would that role be?
I don't really think we do. When it comes to a set of policies like that, that's targeting, the fiscal power of the federal government to what is seen as a worthy cause. It's not really something we can do. We can combat housing discrimination and things like that in lending, but I don't think we are in a position of being able to allocate credit to worthy beneficiaries. That's really fiscal policy.
Okay, getting back to the pandemic, you've implemented a lot of monetary tools during this crisis. In your opinion, have they been sufficient? And if they have, that's the first question. Have they been sufficient?
I think they have. I think the difference really this time is that fiscal policy has really come to the table. It's made a big difference.
Moving forward, have you looked at any changes to that, to the policies, the monetary policy tools that you've used moving forward?
Not yet. I mean, we're looking into that. Of course, we'll do. Right now, our focus is on providing the economy the support it needs. We'll be turning to an evaluation of everything that happened in the crisis and answering that question.
Okay. Thank you, Mr. Chairman. Thank you, Chairman Powell.
Thank you, Senator.
Thank you, Senator Tester. Senator Scott.
Thank you, Chairman Brown, and thank you, Chair Powell, for being here with us this morning. Certainly an important time for us to engage in the conversation about the future of employment in our nation, and one of the core responsibilities of the Fed, of course, has to do with unemployment. There seems to be so few issues right now, Chairman Powell, that actually unites the left and the right. I'm always stunned in Washington when we find something that unites both sides, and frankly, the minimum wage issue is an issue that has united both Republicans and Democrats on opposing having the $15 minimum wage as a part of the COVID-19 relief package. It's good to see my friends on the left coming to the conclusion that in the middle of a pandemic that, according to the Congressional Budget Office, has already shuttered, the $15 minimum wage would shutter another 1.4 million jobs. Their earlier estimate went as high as 3.7 million jobs in the middle of a pandemic that has eliminated 10.7 million jobs. This seems to be common sense from my perspective, from the perspective of Democrats and the Congressional Budget Office. My question for you, sir, is has the Fed economists conducted research on the potential impacts of raising the minimum wage to $15 an hour?
I don't know that we've looked at that question particularly. We have great labor economists who've done a lot of work on the broad area.
Yes, sir. Are there conclusions similar to the conclusions of the Congressional Budget Office as it relates to the negative impact of raising the minimum wage during the pandemic?
Let me say, as I must, that this is a classic issue that the Fed never takes a position on, and I'm not going to take a position on it here today. It's fiscal policy. Most of the research still says that there's some trade-off between job loss and those whose wages go up. But actually, the sort of unanimity of that finding of 30 or 40 years ago is no longer in place. There's a much more nuanced understanding of it. But in any case, it's just an issue where we don't play a role or express a view. But I can share with you the research that we've done. Be happy to do that.
That would be
that our staff has done.
That would be very important, especially as you think of the Fed's responsibility as relates to providing a sustainable economy that includes keeping unemployment as low as possible. The fact that the Fed isn't taking a position on an increase of the minimum wage that is obviously, according to the Congressional Budget Office, going to eliminate the minimum of 1.4 million jobs, I think is an important engagement from the Fed on that issue. I'll ask you a different question as it relates to the COVID relief package of $1.9 trillion. It seems to me that over the last fiscal year, we spent right around $6.5 trillion addressing the pandemic. My question for you is, as we see another $1.9 trillion on top of the 6.5 that we've already spent, what is the impact on the issue of rising inflation in excess of the Fed's longer run objective of 2%?
So, of course, as I said at the beginning, I'm not going to comment today on the proposal that you mentioned, the fiscal package that you mentioned at all. Not our role. I will say on inflation, there perhaps once was a strong connection between budget deficits and inflation. There really hasn't been lately. That doesn't mean it won't return. But again, my expectation will be that inflation will probably be a bit volatile over the next year or so, due in a significant amount to particular things to do with the pandemic. For example, we'll see a slight increase in inflation in a few months because of the base effects that I mentioned. We'll also see, perhaps, we don't know this, but we may see upward pressure on prices as the economy fully reopens, a good problem to have. I don't think that those effects should either be large or persistent. And the real reason for that is that we've had decades of well-anchored inflation expectations, meaning that we've had a very volatile economy for the last 15 years. And inflation has just kind of done what it was going to do. It didn't go up.
Thank you very much, sir. I appreciate your answer. The fact that you're unwilling and unable to answer the questions as it relates to the minimum wage, and certainly you don't want to get into the politics of the $1.9 trillion package. I don't blame you. If I were you, I wouldn't want to get into the politics of it at all, frankly. And I certainly understand your reticence to do so. I'll use my few seconds here to simply say that Congressional Budget Office, some Democrats, all Republicans, all agree that raising the minimum wage is a way to destroy jobs in an economy that is looking forward to a fragile recovery. Thank you, Chair Brown.
Thanks, Senator Scott. Senator Warner.
Thank you, Mr. Chairman, and thank you for holding this hearing. Chair Powell, it's great to see you again. Thank you for the good work you're doing. I think in response to Senator Tester's questions, and when you were talking about the kind of investments we ought to be making that are long-term, particularly as we're thinking about infrastructure, one of the areas, and understanding what my friend Senator Scott just said in your answer, that you don't want to weigh in on the president's most recent plan, I would like you, though, to comment whether you believe that broadband investments fall into that category of the kind of long-term structural change we need. I would argue over the last 11 months, we've seen that broadband is a necessity. I think it is absolutely COVID related. I hope that the current package can be changed to actually include a sizable investment in broadband. As good as our four bipartisan packages have been to date, the broadband investment has been meager or non-existent. Experts like Tom Wheeler and Blair Lemon have said somewhere in the $40 to $50 billion range, we could get about 97% coverage along with better affordability. So I guess I'm asking, would you agree that immediate efforts to close the broadband gap not only represent long-term investments, but also have some direct relationship to the current healthcare crisis?
So as you and I have discussed on a number of occasions, I would agree that broadband is kind of a classic 21st century infrastructure, and one of those things that can support growth. But I of course, can't go anywhere near, don't want to go anywhere near the question of what should be included in the package, if that's okay.
What about the question, though, from a macroeconomic standpoint, broadband and trying to close the digital divide, if we're going to have a fulsome recovery across all socioeconomic groups, could you speak to the question of the necessity for broadband to be ubiquitous if we're going to have that kind of robust recovery, and comments about whether broadband is at this point, a nice to have or an economic necessity, whether it's telework, telehealth, or teleeducation?
No, so again, as you and I have discussed on a number of occasions, I would agree that it is a classic piece of infrastructure for the modern economy, for the service economy, for the technologically advanced economy, and having it broadly available.
Okay, so I truly believe we got all of our answers. We got all of our questions answered, which is basically, I'm going to explain that in a moment, but I think it's no use to keep watching. All the really crucial questions were answered once again. I think this was great speech, and I think the markets are recovering very robustly. It hit this on the NASDAQ, the QQQs that is tracking the NASDAQ. We said it was going to hit that support, bounce back, rebound. However, we are not 100% sure whether this will be the end of the downturn. So we could very well be spiking now and then have a lower high come back down. But yeah, so back to what the Federal Reserve Chairman Jerome Powell just said. Basically, he said he's basically still not thinking about stopping the asset purchases. He might even increase them if the problems arise, right? Might even increase them. He said inflation is it's not gonna be that rampant. He's not expecting inflation to be rising that much. He's also said that in terms of the interest rates, it's gonna remain low. He said the right things. I think there is nothing bad that he said. He said, "Hey, there are some racial disparities in terms of the joblessness." And he agrees that has to be fixed. And so far, he's been very supportive of the economy and the equity markets. And he did say at some point, if we have to increase the living standards for minority groups, we have to do this for everybody. And then as you kind of increase that for everyone, minorities will be well off as well. So surprisingly enough, it was a lot about minorities and minority groups and women, and yeah. But good stuff. I think it was a great, I would say, meeting. I liked what I heard, and made some quick gains as well. Really happy. So, yeah, I think it went okay. So like I said, guys, I've been saying this. It was the dip. And we came back up very strong. Same goes for many stocks out there. Although they have not. They're going to be coming back up, guys. I'm telling you, all these stocks, Palantir just came back up. Like I've been saying, this is a temporary dip. This is no crash. This is a correction. If anything, I'm 100% sure we're going to be coming back up. We're going to see robust rallies in these stocks. It's just going to take some time and some patience. To anybody that got Tesla at 620, well, obviously I'm not a financial advisor, so do not listen to me, but that is great. You got Tesla at a very nice discount, and this was the dip that I was talking about a couple months ago. I said that Tesla stock might go back down quite a bit, and this is it. This is the dip. There you go, 614 at some point. So yeah, good stuff. Very good stuff. Lots of buying coming in. Let me see what's happening with ARK Invest right now. Let me check ARK. ARK is now, it's still down 3.5%, but still, ARK was down a lot for a moment. Let me just go back to... Hopefully I can... Wait, hold up. There you go. I can check the live chat right now. What is happening in the live chat? Let me just refresh. I'm gonna have to refresh that. There was so much... People were spamming like a lot. So, I had to refresh the live chat. Yeah, this was the dip. I've been saying this for the longest time. Dollar cost averaging is the way. Yeah, it's been great. I think this has been fantastic. I got Tesla at 620 at some point. I dollar cost averaged all the way to 620. Had an average price of like 650 at some point. Man, that was just great. Hopefully we see more of these dips. But yeah, this was quite lovely. We will see a lot of gains soon. Yeah, I think we're going to see a lot of gains. I think this is just the beginning. This is just going to be the beginning. Keep in mind, guys, you buy low, you sell high. That is the general rule with trading. Oh my gosh, this is amazing. I think this is going to rebound so damn fast. There are so many gaps right now that have to be filled on the upside. We're already rebounding. Look at that. Tesla came up all the way. This is going to be phenomenal. I'm telling you. I am very positive. The technicals are looking super sweet on Tesla stock, on Apple stock. Everything is looking like it's oversold. I think everything is going to be coming back up quite substantially, if anything. Look at that. It's super oversold. It came back up 10% and it's still oversold. That is how bullish it is right now. I'm just saying, I don't think this is a crash. I think this was the dip. And I think a lot of people missed out on it by panicking. But yeah. You said that yesterday. Yeah, of course I'm saying that yesterday, because you cannot, it's impossible to say that it's bottoming out at a particular level. It could look like it's bottoming out, but still, if you dollar cost average, you will always benefit. Almost always, unless you're in a market crash. But even then, but that's what I'm saying. This is why it's so important to have cash on the sidelines, because if you're all in at a particular price point and we come down, you're stuck. You can't buy the dip. I'm actually euphoric right now, which is bad. But I just literally had a 20% gain on some of my positions, like it was nothing. Like it literally was nothing. It's like fantastic. I mean, buying the dip, in this case, was very beneficial to a lot of people, and yeah, I bought Xpeng at like 33 or something like that. Did it even reach 30? Yeah, 33, roughly 33. My gosh. It's still oversold. It is still oversold on many, many time frames for many, many stocks out there. There are several gaps that have to be filled to the upside. Federal Reserve Chairman Jerome Powell just came in with phenomenal news. This is great. This is fantastic. To be fair, I mean, I've been saying it's been bottoming for like 3 days now, so I have to admit, it's been a difficult one though, because the technicals were looking really awesome, yet the stock market kept falling and falling every single day. Let's see what's happening with your boys CCIV, Churchill Capital Corp. Churchill Capital Corp is now at 43. It filled the gap. Look at that. How neat. It filled the gap. Sweet. I would not touch it with a... I would not touch CCIV. I'm glad I sold my shares before this crash happened, because it went below the price that I bought, that I sold it at. So I sold it roughly there. It even like it went below that price. So I'm very glad that I sold my CCIV at that price. Actually got a premium of 20%. But it's understandable. I mean, there was a lot of hype around CCIV, so I have to admit that. That's, yeah. Origami coming in with a $5 donation. Hey Gara, today Helion has their earnings. What do you think will happen to Helion today and the rest of the week? Well, you have to kind of look at it this way, guys. Okay, you know what? This is not going to happen, right? $30 after what we just saw, what just happened. It makes no sense to go to 30, but I think there is upside. Earnings just recently. Okay, it hasn't happened yet. I don't know much about earnings necessarily, but I do think the trajectory is going to be to the upside, especially if you consider the weekly chart, which is looking quite bullish actually. With Helion, let me just grab the MACD here. Yeah, MACD about to be crossing. So I don't know what's going to happen with earnings. Obviously, I can't know that because earnings is, earnings is earnings. It's kind of a gamble there. But if anything, the trajectory is looking up. So I'm looking at the $25. And if the market rebounds very bullishly, we'll see the $30. But yeah, it's been a great day so far, I would say. I got so many buying opportunities. Bought Palantir 25, bought Tesla at 620, 630, 640, bought Xpeng at 33, bought C3.ai at 115 or something like that. So, I mean, I'm just speechless. Today was insane. Today was absolutely nuts. Wow. Let's go back to the live chat. 101, the Noob Slayer, coming in with a $5 donation. In your entertainment opinion, did buy suggestions? I personally bought C3.ai. I bought some Palantir 25, but 27 looks cheap. Xpeng. I just bought my watch list. I didn't buy NEO because I found it very strange that NEO went down almost 20% at some point. That was looking very manipulated. So at some point I was like, yeah, I'm not going to touch that. I'm not going to touch NEO for a while now because it was going down really rapid in comparison to other assets. So institutions were like really getting rid of those NEO shares. But yeah, in general, I think the dip just, we saw the dip happen. So what can I say? We're going to have to see what the markets are going to do. The QQQs have gone up a percentage point, so that is really great. But yeah. No, I'm not going to be rich, guys. Come on. Don't be like that. But this was good. I think this was great. The stock market deleveraged. We got a nice dip, and it was great. I liked what we saw. I like what happened. I hope we see it again very soon. Although, oh my god, weekly looking pretty bad on the S&P right now. Please do not fall. If the weekly falls right here, it's gonna go down 10%. I'm just warning you guys. If the weekly if it crosses, we're done. Pretty much, it's gonna go down to the 3,600s. But we're on the short term. It doesn't look like that's gonna happen. On the short term, we're gonna get a bounce to the upside, if anything. I mean, that bounce is happening right now. We're filling the gap. Yeah, look at that. Like 1 gap, 2 gap, 3 gap. So, yeah, this was a strong support area. We fell through, though, at some point. Almost reaching... Holy damn. That was insane. So, we almost went below 3,800 on the S&P. Down. That is, like, insane. We'll see what happens. I think we're looking more bullish than anything on the S&P. It's just recovering now, and I think we're going to see more upside coming in. Okay, you're going to be poor. Oh man, this has been an interesting day so far. This has been definitely very, very interesting. Wow, just wow. Yeah, I can only say that. Oh, I received a €25 donation from Koadeng. He says, "Great job, Gary. I can't believe I can make money today. Dollar cost average is the key." Somebody gets it. Dollar cost average, guys. Nothing beats it. Of course, it depends on how you do it. If you dollar cost average 25% of your portfolio at a time, that's not going to work very well. It's just you just be patient. Greed does not help at all. Being patient helps. Being realistic helps. But yeah, dollar cost averaging is the way. It's been working for many, many people. Although you have to always do your fundamental analysis, because you could be dollar cost averaging in a company that goes bankrupt, and then you could dollar cost average forever, but if the company's going to go bankrupt, it's still going to go to zero. So that's a very crucial thing to remember. You cannot do this with like companies that are not very well established. Like, it has to be like a company that is actually making money. But yeah, I mean, today's been like quite crazy. Let me just fix that background noise. Yeah, so let's see. But yeah, guys, make sure you hit that like button. I would appreciate that. Let's get to 500 likes. Let's see if we can do that. I think that would be pretty cool. Also, subscribe to the channel, especially if you are new here. I'm live every single day before the market opens and also before the market is going to close, roughly 4 to 5 hours every single day. If you do not want to miss out, spam click that subscribe button, hit that notification bell so you get notified for the live streams. I would appreciate that a lot. It would really support the channel, and you would not miss out on live streams and on videos. So definitely make sure you are subscribed. Like I said, the stock market is looking pretty solid right now. It's now recovering from that downturn, up roughly 1.5 percentage points since that dip. I think what the Federal Reserve Chairman Jerome Powell said was quite bullish. So I am not worried at all. I think this was just a correction. We're going to be heading back up, and we're going to see stocks probably very soon at all-time highs again. That is my assumption right now. And yeah, so generally speaking, stocks are still looking quite negative, but I think they're going to be coming back up ASAP. So yeah, this was nice buy the dip opportunity, and it's going to take a couple days, but I think everything is going to be coming back up very, very soon. But yeah, like I said, hit that like button right now. Let's see if we're at 500 likes. We're getting close. We're at 350, and like I said, make sure you are subscribed to the channel. That would really support me and the channel, and it would be just awesome. So definitely make sure you are subscribed. Follow me on Twitter. Twitter link will be down below in the description as well. We also have a Discord community that you can be part of. So let me just show you that right now. Let's see. I am so bad at this. I think I can't find it. Oh no. So weird because I got my Discord. Anyway, the point is, make sure you join the Discord. That'll be awesome. Discord link will be down below in the description as well, where we talk about stocks, trading, finance, and investing. We talk about stocks that are about to be breaking out. We're talking about stocks that are about to be selling off quite massively. So the link for the Discord server, like I said, is down below in the description. I'll also link you guys right now through the live chat. So let me just quickly do that so you can join. It's completely free and it's pretty awesome. So let me just spam that right now. Discord community. So make sure you hit that link. Make sure you join the Discord. There's roughly 3,000 people in that Discord right now. That'd be really cool. Gara just wants you to make money. Exactly. That is literally what we're doing right now. Giving the tools and giving the educational, I would say edutainment so that people can make better decisions. Obviously, it's not financial advice, but yeah. Make sure you join that Discord. Discord link will be in the live chat. And we also have Patreon. We have a Patreon where you can get special benefits like early access, buy and sell signals, consultations, the public account. You can see my trades. So if you want to check out the Patreon, if you want to support me directly, you can do that through the Patreon or through PayPal. PayPal link will be down below in the description as well. Manpoo coming in with a $2 donation. Thank you so much, Manpoo. But yeah, Discord link, Patreon link down below in the description and in the live chat. Make sure you join and follow me on Twitter. All right, so let's see if I'm still covering stocks. Tesla's going down a little bit. To be fair, I mean we did see a substantial pump to the upside, so that does make sense. We also filled this gap. Yeah, very neat, very, very neat. I think we're gonna be fine now. Pretty much. Palantir's 27 right now. everything's looking pretty good. Pretty good. You skipped my donation. I didn't skip your donation. I think I didn't. Let me check. Did I skip it? Who's coming in with a donation right now? Joseph Chan coming in with a $5 donation. He says, thanks for your hard work. Do you believe that Apple and Panther would be down substantially, marching back to 120 and 23? No, I don't think so. No, not at all. I think the stocks are going to be rebounding very, very soon. The stock market looks like it's going to be rebounding very, very soon as well. So I think it's going to be fine. I think from here on out, this might instill more confidence in the stock market, with Jerome Powell just literally saying, hey, the printer is going to keep going. And yeah, although if we see like significant amount of inflation or like yields going up a lot, that's going to be very bad. But so far, looking pretty good. Yeah, look at that t-shirt, New York. Super fancy. But yeah, guys, I'm going to be wrapping up the live stream. We've been live roughly 2.5 hours now. Thank you so much for being here. Hit that subscribe button. I would appreciate that. Make sure you follow me on Twitter and support me on Patreon if you want to do that. That would be awesome. So definitely check out the Twitter, Patreon, and Discord. We also have merch. Lucid merch will be down below in the description as well if you want to get some merch. Hoodies, t-shirts, mugs, etc. So all the links are down below. I'll be live again 2.5 hours from now, so that will be very interesting. I think it will be very interesting because we're going to see either stocks rebounding or go down even more. So in my opinion, I think stocks are going to be rebounding quite significantly. So I am not worried. I am not worried at all. This was a correction. I bought the dip. Lots of people bought the dip, and I think we're going to see several dips down in the future. So hopefully that happens, because then you can dollar cost average to the downside and get really nice buying opportunities. So guys, thank you for being here. Thank you for watching. Love you guys. I'll be back soon. Good luck with trading, and I'll be seeing you in a couple hours. Lucid Trading out. Subscribe, like, join the Discord, follow me on Twitter, and